Hi, we haven't seen this for quite a while. Crypto is going down, everything is red. Bitcoin is at 61k, Ethereum is at 4.3k. Does it make sense to buy the dip, to buy your favorite altcoin right now? Or is momentum shifting? That's a question we try to answer in this video. And as usual, we will do technical analysis and we will look at back-tested technical indicators that, statistically speaking, worked in the past. So what you see over here is the Ethereum price, and with it, two moving averages, the 23-day moving average and the 39-day moving average. So in light blue, we've got the 23-day, in dark blue, the 39. And the reason why I look at those moving averages is because of a backtest. When you have a very simple trading strategy where you sell Ethereum whenever the price is below the moving average, so you're completely in cash, your portfolio line is completely flat, while you buy whenever the price is above the moving average, so then you follow the price movements. When you have this simple trading strategy and you try to find out what moving average works the best for trading Ethereum, you see that the 23-day moving average and the 39-day moving average, they historically work the best. So the portfolio line goes up quite nicely. We avoid these long bear markets, but we do participate when prices tend to rise. So that's why I usually look at those two moving averages. I've backtested quite a few moving averages. Here is an overview of all the backtests I've done. And you can see over the testing period, buying and holding Ethereum would have given us 56% and a maximum drawdown from top to bottom of 90%. But when we trade according to the 23-day moving average, those results are way better. So both the 23-day moving average and the 39-day moving average, they work pretty well. Now in this simulation, in this backtest, I have not included any trading fees, any slippage, any bid-ask spread, nothing like that. It simply looks at the daily closes. So according to UTC time zone, that's usually what we can see in charts like the ones that are plotted on TradingView. And so I really just look at the day closing prices. And so right now, we are in a pretty dangerous situation. Now, when we look at the past, this method obviously doesn't work perfectly, right? We do have trading signals that don't necessarily pan out well. So over here in September, for example, we went below both of those moving averages, but then came back up again. But at least when we backtest this, when we look at this historically speaking, those are the best moving averages. So even though the signals are not perfect, they're at least the best what we currently have. And so the price that you see over here, where we currently are at around 4,300, that's still a price that hasn't closed yet, right? We are around 16 hours or so from the day close, so a lot of things can still change. But what definitely makes sense to watch is the 4,200 mark, because that's where the 39-day moving average lies. Now, this is just Ethereum. What about altcoins? I personally treat them quite similarly. So when I'm bearish on Ethereum, I'm also bearish on altcoins. And that's because of the high correlation. When we look at various altcoins and check the correlation coefficient, we can see that Ethereum tends to be higher correlated to various altcoins than Bitcoin is. That's basically true for almost every case over here. So really, Ethereum is leading the altcoin market. It's not necessarily Bitcoin. When Ethereum goes down, the altcoins tend to go down as well. So that's what the correlation coefficient measures, right? It measures how likely is it that at a certain point in time, two assets move in tandem. And the maximum value is 1, the minimum value is -1. So when it's -1, it means the assets, they always move in opposite directions. And so we can see Ethereum has an average correlation coefficient of 0.65, which is higher than the correlation coefficient of Bitcoin with those various altcoins. It's not all gloom and doom, and that's especially if your approach to investing is not timing the market that much, but it's more to dollar cost average and hold over the very, very long term. If you're considering to buy and hold for several years, then this might be a possible opportunity. And the reason why I say this is because of an indicator called the RSI, the Relative Strength Index, measured on the hourly time frame. So in TradingView, we can simply enter the RSI. We take these standard values here, which is a duration of 14, so 14 hours. And over here, we can see that the RSI temporarily has dropped quite low to a value of 16.8 or so. So that was today at around 3 a.m. UTC time. Now, why does that matter? Why does a low value here on the hourly RSI matter? That's because of another backtest result. This backtest looked at the average price you would get when you dollar cost average into Ethereum. And the time frame we look at here is the beginning of 2020 to the middle of this year. So the idea of dollar cost averaging is you buy a certain asset for a fixed amount, say on the 1st of every month. So you don't really try to time the market, you simply just buy at the price that you've been given at this point in time. And so it's really pretty much random what kind of price you get. The only positive effect you get from this is you buy more of the asset when the price is relatively low because the amount, the US dollar amount is fixed, and you buy less when the price is pretty high, simply because you get less, in this case, Ethereum for your dollars when the price is pretty high. Now there's a better way, in my opinion, than simply to buy randomly, and that's by using the hourly RSI. And what you see over here is the results of a backtest. So on the x-axis, we've got the RSI value. On the y-axis, the average discount you get when you buy at a certain RSI threshold. So say when we buy Ethereum, whenever the RSI is at 20 or below, you would get on average a price that's 40% lower than if you simply take a random price. So the way this backtest worked is it just averaged all the prices in that time frame, and then it took a subset of that data where it only looked at the prices whenever the RSI was at around 20. And so the prices at RSI around 20 were on average 40% lower than the entire data set. And so you can see when the RSI is very low, you tend to get cheap prices. When the RSI is very high, you also tend to get cheaper than average prices. And so obviously this is pretty easy to explain. When the RSI is low, we have simply fallen quite a bit. And when we look at this historically speaking, we can also see this price was comparatively low. Then this price over here was also comparatively low. Same goes over here. So we do tend to get lower than just random prices by simply buying whenever the RSI is very low. Now what's surprising is that the same is true when the RSI is very high. And the way I explain this is that's probably because when the RSI is really high, say at around 80 or so, around this level, this means that we are probably starting positive momentum again. So it seems like when we shoot up very quickly, that momentum is turning around and it's turning bullish. So the direction doesn't really matter that much. If we crash down, we've got cheap prices. If we shoot up, we trigger positive momentum. And so if your time horizon is not very short, but you're simply looking for entry points for dollar cost averaging, then this might actually be a good price. But of course, this might not be the only good price. Simply because when zooming out, when looking at the daily time frame, when measuring trends, we are now pretty much at the edge of turning around momentum. This could potentially happen. Nobody can read the future, of course, right? We're simply trying to figure out risk versus reward. And so if your time horizon is relatively short, be prepared that we could potentially fall, right? I wouldn't rule out another 35% drop or so from here. This could very much happen, but if you're dollar cost averaging, this shouldn't matter too much because you're holding over the long term, right? You should be okay to buy again in case it really drops that much. Now, what's also interesting is to look at the relationship to Bitcoin. So Bitcoin is dropping a little bit less. We can see this also by the Bitcoin price in Ethereum. So Bitcoin measured in Ethereum is going up slightly. We can also see that in terms of dominances, Bitcoin dominance is rising, at least a little bit. Ethereum dominance is dropping quite a bit. And the others dominance, so the dominance of small altcoins, is comparatively stable, which is pretty surprising. Usually what happens is when momentum turns around, when momentum is bearish, the very risky altcoins, they get hammered the most. They lose the most, which is not the case right now. So the altcoin traders, they don't yet believe that momentum here is really turning around. I simply would watch for the 4,200 mark. If you're closing clearly below that, I would be very cautious. I would then not be surprised to see the altcoins losing against Ethereum as well, which is currently not the case. If you enjoyed this video, please give this a like. YouTube will then help to grow the channel. And if you haven't yet, feel free to subscribe as well. I publish videos regularly. You might as well hit notifications because obviously those kind of videos, they outdate quite quickly. So you want to watch those videos while they're still fresh. Last but not least, we've got a Telegram channel, the Bitcoin Strategy channel. You can find us simply by clicking the link in the video description or by searching for Bitcoin Strategy channel within the Telegram app. See you next time. Bye-bye.